Kia ora, I'm Ryan Bridge. Welcome to episode 5 of Bridge Talks Business with Milford. Like and subscribe to get next week's episode delivered straight to your front door. Speaking of deliveries, if you're like me and you're a big McDonald's fan, stay tuned to find out what's prompting the global fast food giant to offer customers new meal deals. But first, the top 5 business bits from the past 7 days. Number 1, the US labour market data came in right on the screws, not too hot and not too cold, which is keeping investors guessing how big the Fed's rate cut might be next week, a quarter or a halfie. Number 2, staying stateside, stocks are struggling after awkward August where volatility reigned. Tech shares still battling after that Nvidia result a few weeks ago. Number 3, prediction markets are tightening up as the US election looms. Expect swings and expectations to continue as debates and noise really start ramping up this week. Number 4, across the ditch, the Aussies hit GDP growth for the second quarter of a steady 1% on a year ago. Compare that to an expected 0.8% for New Zealand and the US tickety-boo at 2.5%. Number 5, the European Central Bank is tipped to cut rates 0.25% this week, a welcome distraction from the focus on the US inflation data. This episode, we're doing a deep dive on consumer spending in the United States. It's a key driver of the economy there, a great gauge of the health of the economy, driving 70% of GDP. Now, just a reminder, this segment is informational only and should not be considered financial advice. I am delighted to have Stephanie Batchelor, a senior analyst at Milford, with me on today's show. G'day.
Hello.
Good to have you here, Steph. So tell us, we'll start with this jobs report first of all. It was mixed. Why is it being described as mixed?
Yeah, so there were positives and negatives. On the negative side, the number of jobs added in August came in weaker than expected. And they also revised down the number of jobs that were added in June and July. So then if you look at over the 3 months, we're now at the slowest pace of hiring since the onset of the pandemic. But then on the positive side, the unemployment rate actually ticked down slightly and wage growth came in slightly stronger than expected.
Quite counterintuitive. No wonder it's been described as mixed. The markets had quite a sell-off on Friday, down 1.7%, have pared back slightly. Was that a significant reaction?
Yeah, down 1.7% is significant. And on top of that, every day last week was negative. So it actually ended up being the worst week since the 2023 regional banking crisis. But although it was a weak report, it potentially wasn't weak enough to make the Fed want to jump from a 25 basis point cut to a 50 basis point cut in September. But it's also not off the table. So it is a little bit mixed at the moment. And then we had a few Fed speakers come out over the weekend and they really reiterated what Jerome Powell has said. So they acknowledged that the labour market is cooling, but it's still reasonably healthy. They said there's not meaningful layoffs. It doesn't look like the US economy is headed for a recession, but they're going to remain data dependent. And if the data weakens significantly, then they'll review the pace and the size of interest rate cuts.
So in terms of, because in my mind, I'm like, why don't you just go for a 50, rather for a half rather than a quarter? But I guess they have to wait and see, and I guess it also explains the volatility in the markets and the reaction. It's mixed, it's uncertain.
Yeah, and it is a really fine line as well, because if they cut too much too quickly, they risk kickstarting the economy and having inflation tick higher. And that's what they've spent the last couple of years really trying to tackle. But then if they wait too long or they don't cut enough, that's when consumers continue to rein in spending. You start to see companies be impacted. They pull back on hiring. They might even start laying off workers. And then you're getting closer to that recession scenario.
So it's a tightrope that they're trying to walk.
It is.
What about some of the other metrics like savings for consumers and debt, those sorts of things? What are they telling us about the health of the consumer?
Yeah, so there's a lot of other metrics that we can look at to work out the health of the US consumer. And so retail spending, for example, it has come down lower, more so on the good side, whereas the services spending side is actually still quite strong. But it is just normalizing to more of a historic trend level of around 2%. It's not falling off a cliff. Wage growth is moderating, but inflation is also coming down. So we still do have real wage growth, and that's generally supportive for spend. And then you mentioned excess savings. There's a lot of talk out there saying, all the excess savings from COVID are now spent. But it's important to keep in mind households have built up an enormous amount of assets over this time. COVID was the first recession where wealth actually increased rather than decreased. So since 2019, house prices are up kind of 50%, equity markets are up 70%. And then on top of that, debt obligations are still remarkably low. A lot of homeowners in the US fixed their mortgage rates at around the 4% level. So debt obligations are low. The one area where debt has picked up a little bit is in that lower income consumer. So things like auto loans and credit card debt. So that's something to keep an eye on.
Things you need, if you're on a lower income or if you're on a fixed income, that you need to borrow to survive, right?
Exactly. So overall, the health of the US consumer is cooling, but we'd say it's still on reasonably solid footing.
Okay. As an analyst, you're obviously looking at the big US companies and getting a sense from them about their view on the consumer and how they're faring. What has their messaging been?
It's mixed as well. I keep coming back to that. But if we look at some of the bellwethers, so these are companies that provide quite a good read-through on the economy. Take Walmart, it's the largest retailer globally. They actually had a fantastic result, but they did say that the consumer is more choiceful, value-seeking, and focused on the essentials. On a positive note, they did say that they're not seeing any incremental fraying of their consumers' financial health. And then we could look at names like Visa and MasterCard. Visa said they are seeing weakness in that lower income consumer, whereas MasterCard was a little bit more upbeat. They said that irrespective of income cohort, they see the consumer as quite well supported, backed by that strong labour market.
Right. All right, now is my favourite part of the interview because I know you're going to talk about a big company, which I'm a big fan of, and that is McDonald's. First of all, most important question, what do you get at the drive-thru, Steph?
It's embarrassing, but I get a fillet of fish.
Really?
That's
really weird.
It is an interesting choice. What do you get?
I get a McChicken. I used to be a fillet of fish.
Okay.
Fillet of fish. I don't know.
Potatoes.
Can't be that fancy, can we? Anyway, what are we hearing? Because they're making an interesting move in response to dip in sales.
Yes. So McDonald's has been raising prices for years, and now consumers are starting to really push back. They're saying it's too much for these products. And so in the quarter, we actually saw, for the first time in over 3 years, McDonald's global sales decreased. And the CEO said that they're seeing it more in that lower income household. But as a result, they're now starting to introduce more value meals, more value options on the menu to try and reestablish that value perception and win some of those customers back.
It's interesting, isn't it? Because when you get a product like McDonald's, which, don't get me wrong, I love, but when it's nearly $20 for a combo and you start comparing that to something that might be a little more boutique or higher in nutritional value or something like that, a consumer starts to make decisions, don't they?
Exactly. And we've seen a lot of consumers just start to eat more at home as well, going to the supermarket, even buying sort of to-go meals or something like that, rather than going to the McDonald's of the world.
True. Now, Steph, I've got an example for us this morning. Ironically, these two products are almost considered staples. One arguably wouldn't be good for your teeth. The other generally considered to be good for your teeth. Tell us about what staples like these brands are faring at the moment.
Yeah, so I'm glad you got the branding right. So consumer staples companies have been performing much better than consumer discretionary. And because investors are worried about this economic slowdown and consumers pulling back spend, that's typically the environment where discretionary items like apparel and footwear really suffer, whereas people are still going to spend on things like toothpaste. So Colgate Palmolive has actually been one of the best performers year to date. And of course, on really strong brands like Coca-Cola. I mean, I know Coke shouldn't be a staple, but it does become quite ingrained in people's habits. And some other names that have also done well in athletic footwear, for example, there are names like On Footwear or Deckers, which own Hoka, as well as the UGG brand, Asics, Adidas. They've all been doing very well at the expense of the likes of Nike, Puma, Under Armour. So it is quite brand dependent in that space. And then restaurants. So McDonald's not doing so well, but you still have names like Wingstop and Shake Shack, which are continuing to perform because they have quite an attractive store rollout strategy ahead of them.
Right.
And then Walmart, another one, doing great at the expense of dollar stores.
So it's an interesting dynamic. We're talking about price-conscious consumers, and you would think in a price-conscious environment like that dollar stores would be doing really well. You mentioned them, that your $2 shop equivalents would be doing really well, but they're not. What's going on there?
Yeah, so this is an interesting one. Dollar General reported about 10 days ago, and shares were down 30% on the day, which is its biggest ever one-day move. And
Wow.
what they said is that their consumers are finding it hard to make their budgets last to the end of the month, and 60% of their customer base is finding it difficult to afford the basic necessities. And then Dollar Tree, another dollar store, also reported, and shares were down 22%. So another huge move, and it was sort of a similar dynamic going on to Dollar General. And it is interesting because, as you say, you would expect these companies to do well in this sort of environment where people trade down, they're looking for value. But the stocks are now down 40 to 50% year to date because it is really that lower income consumer that is struggling. And you're also seeing the likes of Walmart and Amazon creep in and take share from them.
Let's talk about the other end of the market, because we've been talking about that more price conscious and price affected end. What about your Gucci's and your Pradas? I don't know, your higher end stores and chains.
Yeah, the luxury names.
Luxury names.
You would expect that, you would assume that a higher income consumer, a client base, would actually be holding up okay, and these companies would be doing well. But what we saw was that during COVID, there was a lot of government stimulus, and there were not many options to spend your money on. So we saw a lot of the lower income, middle income consumers start to spend on luxury products, and they entered the category. And of course, that has now fallen away and reversed because inflation and rates are impacting them. And so we're seeing a real divergence in these companies. If you look at the companies within luxury that really focus on that high income consumer, they're names like Hermes, Brunello Cucinelli, Ferrari, even though it's a car brand, it's very much luxury.
You're better at naming these good brands than I am, by the way. I'm like Gucci.
Lots of practice. They're holding up okay. But then if you look at the companies that really benefited from this aspirational consumer kind of moving up, that's names like Gucci, Ferragamo, Burberry. They're struggling a lot more. And then across the board, they're all being impacted by a continued deterioration in the Chinese consumer. So if we look over the quarter, I think it was 90% plus of luxury names actually missed expectations.
Yeah, wow. Because that Chinese market is huge for the luxury goods, isn't it?
Yeah.
And even you've got Chinese buyers now, taking stakes in these companies. They're sort of taking over. Let's talk about housing, because the housing market in the US obviously has been weak, which has a flow-on effect for the consumer. Have those companies like, and I'm using a New Zealand example here, like your Mitre 10s and stuff, how are they faring?
Yeah, so the names in the US that are like the Mitre 10s and Bunnings, that's Home Depot and Lowe's, and they have been weak. So they called out that they're seeing softness in big ticket discretionary items, things like outdoor furniture and appliances, as well as project-related spend, bathroom renos, kitchen renos, flooring projects. And they said consumers are just sitting on the sidelines. They're waiting for those interest rates to come through before they spend. And as for when we're going to see green shoots, it's hard to say, because there is this lock-in effect in the US where most homeowners have fixed their mortgage rates at kind of a 4% level, and current mortgage rates are still in the 6s. So even if we get a couple of interest rate cuts, it might still be a while before you get people re-engage in housing and housing-related spend.
Yeah, and some of them are fixed for, well, most of them for like 30 years, aren't they, over there?
30 years.
Very different to us here in New Zealand. Speaking of us here in New Zealand, are there any comparisons we can make between the consumer in the US and how they're faring with, obviously the price conscious, the interest rate situation is different on between our two countries on both sides of the Pacific. So can we read anything into the health of their consumer vis-a-vis ours?
Yeah, so there are similarities and differences. It's similar in the sense that consumers in the US and in New Zealand have been hurt by high interest rates and inflation. But it's fair to say that New Zealand consumers are more impacted by higher interest rates, and it comes down to our mortgage structures. In the US, they're fixed for 30 years in terms of the rate, whereas here we're much shorter term. So we feel that pain of higher interest rates much more quickly. And you can see it in the relative housing markets, very weak house prices here in New Zealand, whereas in the US they've actually held up surprisingly well. But on the positive, it means that we'll see that benefit come through more quickly as interest rate cuts start to happen.
Really interesting. Stephanie, thank you so much for being with me this morning.
Thanks, Ryan.
Really appreciate it. That's a senior analyst at Milford, Steph Batchelor, talking about the health of the consumer in the United States. Remember that consumer spend drives 70% of GDP in the world's largest economy. Thank you so much for watching. Don't forget to like and subscribe. See you next week.